Now let's do some journal entries with voluntary health and welfare organizations. So we got pledges of $200,000, and 5,000 of that pledge of those pledges are going to be temporarily restricted. So I'm going to debit pledges receivable. It is kind of a problem here that it's a pledge receivable, but it's unrestricted because you can't spend it. And you would probably need to reclassify this at the end of the period. Debit pledges receivable, you need to reclassify it as pledges with donor restrictions because you can't spend the money yet because you don't have it. Temporarily restricted of $5,000, and credit contributions unrestricted 95,000. I guess as long as you can spend it within the year, you get the money and you can spend it within the year. Then it's okay. Provide for estimated uncollectible pledges is 20%. So the journal entry there, we're going to do 20% of each. I'm going to reverse this. Or rather, I'm going to reverse the contributions. Debit contributions unrestricted. That would be 95,000 times 20%. And credit allowance for uncollectible pledges. Unrestricted, 19,000. And then I'm going to debit contributions temporarily restricted, 5,000 times 20%. And I'm going to credit allowance for uncollectible pledges restricted, $1,000. And then we're going to collect some pledges. So I'm going to debit cash unrestricted. So we're collecting now $85,000. So let's first collect the money. I'm going to debit cash unrestricted for $85,000 and then credit for that. I'm doing this a little differently from the book. I hope you don't mind, but how the book does this doesn't completely make sense. Pledges receivable of $85,000. We have the temporary restricted pledges. So I'm going to debit cash temporarily restricted of $5,000. And these, there's a specific requirement in these that we cannot spend them for a period of time of $5,000. And then I'm going to undo all of these allowances because I've collected the whole thing. Yeah, reverse previously recorded allowances that were not needed. So I'm going to debit allowance for uncollectible pledges, unrestricted. This is the kind of thing where if I put it on a quiz, people would not know what to do because it's so simple. They'd be like, that's it, really? You ever take that? You take an exam and the professor asks a question, you're like, the professor bunts. That's what we call it. We call it bunting. I bunted on this exam. And when you bunt, the students get it all wrong. Because like, oh, I thought you wanted me to do, and they asked for some huge thing. And like, no, you just had to do this. We don't do that on purpose. Like, I want to do people a favor, so I make the question easy. Write off uncollectible pledges in unrestricted assets. I don't know where that came from because I just eliminated all my uncollectibles, but anyway, debit allowance for uncollectible pledges. I can't spell pledges. Unrestricted, $3,000. And credit pledges receivable unrestricted, $3,000, like so. Next, we classify temporarily restricted cash for unrestricted uses. So debit cash unrestricted, because that's what you're getting, into unrestricted, and credit reclassification of contributions to unrestricted. And we're doing this without funds in this situation. They're just doing it all in one set of accounts. There's no specific funds, which is one option for doing this. So we're taking this out of reclassification of contributions from temporarily restricted of 5,000. It's going to come out of that cash account. These entries go together. So in other words, the cash is coming out of restricted cash and it's going to unrestricted. And then the donor agrees to contribute $10,000 per year over 5 years, and the net present value is $39,927. So debit pledges receivable, temporarily restricted because we don't have the money yet. For $39,927. Credit contributions, temporarily restricted, $39,927, and we receive the first payment of $10,000, so that's going to be cash unrestricted because we got the money. I'll credit reclassification of contributions to unrestricted of $10,000. And then I'm going to debit reclassification of contributions from restricted, also for $10,000, and credit pledges receivable temporarily restricted, $10,000. There you go. So now I've got that $10,000. I've also got interest income of $31.94 on this because it was recorded net present value. So I'm going to debit pledges receivable, temporarily restricted, for the amount of interest, $31.94. Does it say what it is? Oh, they just give it to you in the problem. But you know, it's a time value money problem. Contributions temporarily restricted, $31.94. So the amount of pledges receivable is going to go up as time passes on. Now we receive we make a mortgage payment out of unrestricted assets. So for some reason, mortgage payables and restricted assets. Here we go. Reclassification to restricted assets of $2,000, and then credit cash unrestricted of $2,000. And I'm going to move the mortgage payable. For some reason, the mortgage payable is in restricted assets. I can't tell you why, of $2,000, and credit reclassification from unrestricted assets, $2,000. The CPA donates an audit. From what I saw, they could use an audit. So debit expenses, supporting services, $3,000. And credit support, donated services, something made about this. Because the CPA donating an audit, that meets all of the criteria for donated services that needs to be booked as revenue. And then we have various kinds of depreciation and other expenses. These are all depreciation expenses of different things. So research, I don't know why this is, but I'm doing it, man. We're going to finish this. Research is depreciation of $4,300. Public health depreciation is $1,000. Professional training depreciation is 2,000. Community services depreciation. I guess this is different aspects of the business, the organization, but this is very important now. Management in general needs to be broken down, even for depreciation, because that's administrative expenses. So you need to keep track of depreciation on administrative assets separately from, or you need to allocate it separately from, and you need to definitely allocate fundraising depreciation from the other types of depreciation, because that expense is going to be recorded separately when you file your 990. 990 being the tax return. So there you go. That's voluntary health and welfare organizations. And next we're going to go to other not-for-profit organizations. And today the distinction between other not-for-profit and voluntary health and welfare is not that significant.